Happy Friday, everyone. The market's up. So we wanted to do a video mainly because this week especially, the market has seen a lot of down days where significant drops. And so we know that when there's one day, when there's then 2, 3, 4, we need to explain some things. We need to kind of share and show you what we're seeing and provide some hope for what we're seeing, and that there will be an end, but just to explain some things and what's going on in the market. So I have Rob here, and I just have to share, Rob will never be called the expert because he hates that. But I have to say, like, I always appreciate Rob that he's investing, researching, reading about history, times that have happened in the past, his experience. And so often we have so many conversations of, this feels like this time back in history when we were experiencing it as advisors. And so I just appreciate that about Rob. So we won't call him the expert because he doesn't want to be. However, his insight is very valuable. And I believe that you see that in your portfolios and how things are playing out now. So I appreciate that about you, Rob. And I know clients do too. So today, instead of him writing something for us, we're going to talk about it. And hopefully we can explain, a lot of different questions. So we're just going to back up to really the beginning of this year. Rob, kind of explain, what have we seen so far? What's happened, what's happening? And then we'll talk through that.
Yeah. So this year, I hate using the word unprecedented because politicians use that all the time, but it really has been a very unique year. If you look at if we just take a step back, like the stock market this year, at least through yesterday, was down almost 20%. And I haven't confirmed these numbers, but I was reading something yesterday afternoon that said that this was actually the worst start to the year since 1932.
Wow.
Which is crazy when you think about it, that with everything that's gone on the last 85 years, that this is one of the worst starts ever. But it is what it is. On the bond side, it's the worst start since 1981. So you've got 41 years that we haven't seen a start to the year like this. Any one of those things happening in a given year would be very newsworthy. The fact that they're both happening or have both happened at the same time is, again, I hate to use the word, but unprecedented. So it's been a very, very, very historically unique period so far this year.
Okay. And we'll pause there and say, when we're doing videos, especially like this, where it's what's happening in the market because things are happening, we just want, the point of this is to bring calm, to bring understanding, knowledge to you, so that in the midst of these unprecedented things, so these times that we're all saying, great, I'm so happy to be living during the worst times that we've seen. I mean, nobody really wants to be able to say that. And even when we say, oh, we're not down as much as the market is, that isn't really comforting completely. However, we do just want to share this to bring kind of a peace and a calm to say, okay, let's understand what's happening, because I think that helps us to then see through to the other side. So just to say that we're not making light of this, and we understand that this can be hard to see from your side. So all right, so when we back up, we see we're starting off this year really rough. So talk us through why. There's always something that they say this is different because of this. So tell us what's happening now.
I mean, what's really different, and I mean, we've been writing about this for a year and a half, 2 years. This view that we are moving into a different investment regime. We've been in this very low inflation environment for the last 40 years. The last 10 years, the Fed has had ridiculously easy monetary policy, but the pandemic changed something. And it wasn't just a pandemic. There were also signs of pricing pressures starting to come in, like labor shortages and things like that, even prior to the pandemic. But basically what has happened is inflation has gone way higher than anyone expected, way higher than the Fed has expected. So really, since the beginning of November last year, the Fed has done a 180 from providing unlimited stimulus to now trying to catch up to get a hold of inflation. Just this morning, actually, the University of Michigan surveys consumers every month, And consumer sentiment right now is as low as it was in 2008, which is, you know, having lived through that and seen that, like to me, that the world was ending in 2008. This today does not feel that way. But consumers are just as downbeat, and it's because inflation is out of control. And the Fed and all the politicians in Washington are freaking out that they have to do something. So now the Fed is jawboning the market that we're going to get this under control.
Okay. And back then it was kind of that you had businesses that were too big to fail. It was a different type of stimulus. It was different types of things. So this is just different that we're seeing. And so it's helpful to understand what's causing it. So inflation, everybody's feeling that in their pocket on all of their spending. So then monetary tightening, if you're going to buy a home, rates going up, that's affecting you. So then, okay, so we see what's causing it. So when we look really far ahead, do we see, or even right now, I guess let's say right now, do we see anything that's kind of starting to stabilize? So we see, okay, it's rough. We've had a really rough start to the year, and it's we're almost 5 months in. So what are you starting to see? Is there any hope that you're starting to see signs of?
Sure. I think, you know, I always say the markets follow what the Fed is doing. So, you know, we've gone from November 1st of last year, the consensus was the Fed is not going to raise interest rates until 2023 or 24. And you look at what is priced in right now, the market is saying that within the next 12 months, interest rates, short-term interest rates by the Fed will be over 3%. So we have already had this huge shift in expectations. You know, so if we look forward here, and this is what I always, you know, tell people, you can't necessarily look at what's happening today and try to figure out what to do. You have to figure out what's going to happen 6 or 12 months from now. And my personal view is the markets have already fully discounted what the Fed is going to do. So the Fed short-term interest rates are only 1% right now. If they go to 3%, frankly, I don't think that is a market moving event, because that's already priced into the market. So, you know, when I look ahead 6 months, you know, or look at the market today, I should say, we've already priced in a very, very aggressive Federal Reserve. So the question is, well, what is the world going to look like in 6 or 9 months? And inflation, again, in my view, they released it this week. It was worse than expected. Next month will probably be worse again, because gas prices continue to go up. But I do think that towards the end of this year, we're going to start seeing inflation rates come down. Maybe not go negative, but they won't be 8%. They might be 6 or less than that. And you know, at that point, I think we are starting to see signs that we've already incorporated the worst or the most of the Fed move into the market already. So
I think that's helpful too, because when you first started talking about it, and the market's priced in that the Fed's going to be at 3% or over with interest rates. Well, the Fed has moved rates, so it's 0.25% first, and then later at a different meeting, like what, 6 months later, or 3 months later, 2 months later, another 0.5%. And we were kind of like, hopefully they'll go like 0.75%. Like we want them to start making meaningful changes. But even just seeing how slowly and in small amounts they're raising rates, I think that's why it's hard to think that they're going to be over 3%, since it's taken them so much to get to where they are now. So.
And I mean, what the market is really, the sell-off this week and at the end of last week, I personally think is because the Fed had a meeting last week and they said, we're not going to be too aggressive. And that is a problem. I mean, inflation is so out of control. The market wants to see the Fed on the front foot. They want to see the Fed getting ahead of this thing. So by, you know, trying to, you know, be lukewarm with the market and say, well, you know, we're going to raise rates, but not aggressively. I think the market took that as the Fed is going to remain behind the curve. And the longer they're behind the curve, the longer inflation stays high, and the longer inflation stays high, the more aggressive they'll have to get later. So I think they're getting that message. And I think if the Fed comes out and says, we're going to raise 3/4 of a point or maybe even a full point. Frankly, I think that would be really bullish because that would be a sign that they get it. They're getting ahead of the curve, and the quicker that they get ahead of the curve, the quicker we get to that point of the next part of the cycle, which is
take us there. So so where are we going? So we kind of have this, how do you see this playing out in the stock market? Just kind of walk us through what you're thinking or you see.
So it's, again, following the Fed. What is the Fed doing? I mean, we're in a very aggressive tightening cycle right now, but every tightening cycle is followed by an easing cycle, and it just kind of continues on and on. So I think to the extent that we kind of get to that place where we're fully baking in what the Fed is going to do aggressively, then investors can start looking forward to that easing cycle. It might not happen immediately, particularly with inflation, and I seriously doubt we'll ever see 0% interest rates again in our lifetimes. I mean, I think that is just not going to happen ever again. But I think we're getting to that point where if the Fed can just get ahead of this curve a little bit, then investors can say, okay, we know they're going to hike aggressively, and we can start looking forward. I do think, I mean, from a bond standpoint, so if we look at breakout portfolios into stocks and bonds, my sense this week is bonds are starting to find a floor. So they've had a terrible start to the year, but if you look at how US government bonds have reacted this week as stocks went down, is those bonds actually went up. So they're doing what they're supposed to be doing. If stocks are going down a lot, they're acting like a safe haven.
And they haven't year to date.
And they had not, they had not up until about late last week. But this late last week and this week, if you look at stocks versus bonds, bonds have held up a lot better. So I think that's a really good sign that at least on the bond side, the market has kind of found its footing and maybe a near-term bottom. Stocks, I think, probably still have to digest where things are going to go from here. And, that's where we can kind of talk about that a little bit more.
As I was going to say, walk us through that. So we talked about bonds, now stocks. Remind us, like, what does this feel like? So when we think about the recession, the financial crisis, 2007, 8, 9, tech bubbles, like these are just big ones that we've walked through. Like, does this feel like any of those?
Yeah. So to start off, the first thing I would say is even with the drop, if you look at annualized returns for the S&P 500 over the last 5 years through yesterday, annualized returns are 12.5% positive. So the long-term average is, call it 9 to 10%. So even with a drop, I think all investors have to appreciate that the last several years have been so good that even on average, you're still doing better. This stock market, I think, I started my career in the late 90s. I went through that tech bubble, on the way up, and then obviously on the way down, and seeing that firsthand. This to me feels a lot like that. I think a lot of the same characteristics that marked kind of that period of time, we're starting to see now. And it really starts with, back then it was all .coms, internet everything. It's gonna, the new economy, it's gonna take over the world, and all these companies came out of nowhere with .com at the end of their name, and we're gonna rewrite history. And 90% of those companies went out of business because they were just a fad. I mean, the underlying structure of the internet was a great thing, but the business models were not good. And I think in the last 5 years, because the Federal Reserve has been so easy, there's been so many of these, tech IPOs that have come public that frankly have horrible business models. They don't make money. They burn cash like crazy. Those stocks since the beginning of November are down 80%. I mean, on average. So, and that's exactly what we saw in 2000. It was the first dominoes to fall were those crappy tech stocks that had no prospects whatsoever. Investors finally got fed up. Their stocks went down and never came back. So I personally think with a lot of these stocks that have gone down 80%. The vast majority of them will never, ever come back again.
Yeah.
So how did it play out? You know, the question is, well, how did it play out in kind of act two? Then what happened, and what was unique with the 2001, 2002 experience is you had 9/11 in there. So, you know, we have to kind of put all this into context with that. But, you know, what happened after those first dominoes fell is the economy fell into recession, a very brief and mild one, but it did fall into recession. And what you saw is that recessionary period started hitting, you know, bigger companies and more mainline old economy companies and all that. And so, but surprisingly, because those stocks never went up during the bubble, they actually did okay. So it wasn't like there was this other leg down or anything, but
it's kind of a cleaning out of businesses that are actually profitable businesses that sell products that people need or services that people need and use. And as long as you have a demand for that and your business is working, it's profitable, and so you can continue doing that, then it works. But if it's not, I think this is what kind of sifts out those companies. Times like this really sift it out. There's kind of a thought where a lot of times, like when things are good, you don't see the things that aren't working or the bad things underneath because everything's so good. So we see, I guess, these rose-colored glasses. It's times like this when everything isn't good, they were kind of like, oh, well, let's see everything underneath. And so that's all the underneath stuff, I think, that we're starting to sift out too. I mean, even just like yesterday, we started seeing kind of confirmation of like stories about cryptocurrency and things. And, you know, these are things that we talk about all the time. Clients ask about them, and we never want to be someone who's like, no, don't invest in something, the newest, latest, and greatest. And so we research and we read and we try to understand, is this really the next newest, latest, greatest, like good thing? And so it's hard when we say things like, this feels like, you know, something from a .com bubble. So crypto's kind of always felt a little bit like that to us, and not saying that there will never be something good from it. We don't know, but we're starting to see stories like this. So that's even something, it's kind of this sifting. Okay, was this a real thing? So any thoughts, I guess, on that specifically?
Yeah, actually, that's a perfect way to put it. You know, what I would expect is going to happen with the stock market. I don't know how long it's going to take. Is we are going to go through a cleansing process. The removal of 0% interest rates by the Fed is going to expose a lot of business models and, you know, just crap that has been going on for years that should not have happened.
Just cheap borrowing of money. When rates were so low, they could borrow money for next to nothing and then use it however they want.
So crypto is a great example of this. I mean, it is going to go through a very, very deep cleansing. And, you know, you're already seeing it this week where like the fourth largest coin went down 99% in 72 hours. And, you know, we are going to see this cleansing. And the cleansing, if you go back to the tech bubble of 2000, the cleansing was, you had businesses like Enron and WorldCom and Tyco. You had a lot of corporate scandals and accounting scandals. I fully expect that as we kind of go through this period over coming months, we may see surprising headlines like that, where, you know, you look and a company or some investor was doing something so dumb and you're just like, they were doing what? We will probably go through things like that, but that doesn't necessarily mean the entire market goes down. It just means that there are pieces of that market, which we'll get to in a second, that we've specifically avoided. There will be pieces of the market that are going to get fully cleansed out through this. But at the end of the day, what we want to remember, and I guess we can kind of move into that.
Exactly. I mean, this is where it's really kind of watching for all these things. This is where I want to highlight so when I mentioned, Rob, you're always looking ahead. So many times, you know, people will ask, what should I do right now? And we will say, well, we did that 6 months or 12 months ago because we believed that these things were going to happen. And so it's this forward looking. I remember last year, I think you were reading about the 70s, and, you know, it's stuff like that where we're always trying to think, what does this look like in history? And so we were making these changes 6 months, a year, 2 years ago, because we believed we would see these things. And so, yeah, walk us through what we've done, how it's working,
Yeah.
some of those pieces specifically that we're
Yep.
talking
Yeah.
about.
Yeah. So, I mean, just a couple of things. So, flashback a year, I was really concerned that the market, specifically large cap stocks, the
Yeah.
S&P 500,
Yeah.
was just massively over concentrated in technology stocks and massively dominated by a handful of very large tech companies, like good companies,
Yeah.
Microsoft, Apple, Google, Amazon. But if you looked at the index, if you were buying that index, you were basically buying 25% of 5 or 6 tech stocks.
And this
and
is
then
just the S&P 500. Like I'm
Yeah.
just buying the S&P 500 stock index.
Yeah, which almost everybody does.
Yes,
Because
exactly.
that's the easiest, lowest cost thing to do.
Right.
You know, that to me, it just seemed like there was way too much concentration. So a year ago, we moved into an equal weight S&P 500 index fund, which owns the same 500 stocks as the regular index, but it just owns each of those in an equal weight.
Yeah.
And the thesis was, you know, while we think, you know, Apple and Microsoft are great companies, they've just become way too dominant relative to the value of the other 495 stocks in that index. So if you look at how that's done over the last year, it's been pretty much scratched. But if you look year to date this year, that equal weight index is outperforming the regular S&P by 4%. So, you know, it's still down with the market, but, you know, these are the kind of things when you're investing for the long term, you can't simply avoid downturns. So the name of the game is trying to make sure you're positioned well for that.
Yeah. Yeah.
Yep.
So then talk through, okay, so we had the equal weight. So then just less interest rate risk in general. And this is more so on the bond side as well, right? So maybe just walk through. So what did we do to kind of position for that and how's that working?
Yeah. So again, a year ago, looking at inflation and thinking the Fed is going to have to do something at some point, what we did is we shortened the interest rate risk, or we reduced the interest rate risk in all of our client portfolios because of 0% rates that we've had for really the last 12 years. A lot of companies and the government and everything have been issuing very long-term debt at very low interest rates, because if you can do it, if you can issue debt for 30 years at 2%, it's like, who's not going to do that? The problem is when interest rates go up, that those very long maturity bonds, their prices will go down a lot. And so if you got to look at the indexes that you're invested in. If you're just invested in the regular big Barclays, Bloomberg aggregate bond index, the interest rate risk embedded in that index actually went up significantly over the last 10 years. So what we did is we said, you know what, we think inflation's a problem. We think interest rates are going to have to go up. So what we did is we just reduced exposure to interest rate risk. Again, just like the S&P, it doesn't mean the value of bond funds that we own and our model have not gone down. They have gone down, but again, they've generally gone down less than if you're just invested passively in whatever the big bond index is.
So it's more investing kind of the shorter term for now anyway, or when you made those changes, it was kind of, let's get in shorter term bonds. So not in ones that have this, you know, longer time horizon. So then more risk. So that's kind of, we were making changes like that.
And there's really two benefits to that. Number one, it helps avoid big price declines in bonds. But secondly, because our client bond portfolios are in shorter maturity bonds, their yields will start recovering a lot quicker because a 2% bond is going to mature in 2 or 3 years, and that's going to be replaced by a bond yielding 4 or 5. So
that makes sense.
You know, we've been, especially our older clients, have been suffering with bond yields at extremely low levels. That is actually going to start improving. So, you know, so that's, and because we made those changes a year ago, that's going to happen a little bit quicker.
So the bond market's kind of starting to find its footing, or what we feel like it's kind of starting to stabilize or stop dropping so quickly as it was. So is this where you kind of see like, this is where we'll start to see this benefit, or over time still?
Yeah, it's going to take a while, just because the nature of bonds, they have to mature
Okay.
and get replaced by different bonds. So it's not going to happen overnight,
Yep.
but in some of the shorter term US Treasury bond funds that we're invested in, I mean, those yields are going to go from 0 to 2 or 3% in the next 18 months,
Yeah.
which,
That's good.
you know, for investors who have, there's been this saying out there is no alternative, Tina.
Yeah.
You know, that's been the case because bonds yield 0. So it's like, well, you got to throw it in stocks. Well, I think with interest rates backing up, investors are going to have an option. They're going to be able to get 3% in their bonds or 4% in their bonds again.
Yeah.
In the relatively not too far distant future. So
yeah. Well, that's encouraging. And I think those are the things where now it's kind of, okay, we're in the midst of this. What have we done? What are we doing? And this is naturally where people say, when the market kind of keeps going down like this is where it's like, what can I do? Because I think a lot of times people feel helpless and you feel like I should be doing something or we should be making changes. But this is where we say, well, we made those changes 6 to 12 months ago. So if we see that the market's starting to find footing, now we're saying, well, where's it going to be? We're always kind of this forward looking in the next 6, 12 months. Is there something we need to change today for then and where we're going? And so, so this is where when we kind of say, what should we be doing right now? You know, and there's, this is what you're always looking at, what changes should we be making? And so this is where you'll be watching for, okay, are there significant changes happening, but nothing right now where there's not any big changes that we're looking at. We're just saying we kind of need to hold tight with what we have. What we did is working, and now we need to let it continue working. Is that kind of the overall?
I mean, I think we're still early in this cycle. So I think bonds, for example, have potentially found a near-term footing. That doesn't mean, oh, let's buy 30-year government paper again, because my view again, over the next 10 years, inflation is going to be higher than what it had been for a long time. And that means interest rates are, you know, likely to have an upward bias over time. So this doesn't necessarily, what has happened so far doesn't necessarily mean it hasn't caused the need to make any radical changes quite yet, but obviously we're, you know, watching this very closely. On the stock side, I think, you know, again, I think this is going to be a cleansing process. We've gone from the most insane speculative environment of any of our lifetimes as recently as November to something much different now. It is going to take several months for that to play out. So, you know, I think sticking with what the changes that we made a year ago to help insulate client portfolios from that, you know, we're not married to any of these positions. So as the market changes, if the regular S&P 500 suddenly becomes, you know, a lot less concentrated in tech and some of these huge companies, I mean, we have no problem moving back into that, but we're just not there yet.
And I think that's really the thing that we're kind of watching for is, you know, when our goal is to be down, you know, in a down market, things are going to be down. We're going to stay invested, but we're going to be diversified. And so when the market's down, the goal is that, yes, it's down and that isn't ever exciting or comforting to share. However, our goal is to be down much less or less than the market is, so that when it comes back and when we think we're at that point to shift into things that are going to come back quicker, that's when we'll move into those things we didn't have to experience the full downside of those aggressive things. We kind of took the risk out, said we're going to be down less, and now we'll get into those things that will rise quickly. So that's kind of the thought process of rotating in and out of certain things based on, again, what we see in the future.
And that's, I mean, that's pretty much how it's worked out year to date. I mean, every client's different because every client owns different stuff and whatnot.
But at different times.
But I mean, generally speaking, our models have outperformed a straight index balance fund, like a 60-40 balance fund from Vanguard. I mean, our clients are generally outperforming that by like 2% or so, which doesn't sound huge when you're down 10 or 11, but I mean, these are the kind of things that add up over time. And that's really what we endeavor to do, is to try to, you know, really protect on the downside, especially.
So investing is one piece of our plan. So then when we talk about kind of back to the what can we be doing?
Yep,
Because we
yep.
all feel like we need to do something when the market's down. I need to be doing something. It'll make me, I think it makes us feel better when we're
Yeah.
doing something to help it go back up. And so even though I don't think it does, but practically when we say, okay, the market's down, so what can I do? So let's just talk through some of these. So we always kind of, like you've said, go back to the basics of financial planning. The biggest thing that we tell people is you have a plan, we stick to that plan. And so these are the hardest times to stick to that plan, because we go through the cycles of going in a down market and then coming back up, but over time it averages out. And so these are the times where we need to be reminded, stick to your plan. Now in that plan, for example, some of you are making IRA contributions each year or adding money to your 401ks or retirement accounts. These are the things you need to continue to do. These are the things that as you add money every year, so in the last few years, you've been adding money when the market's been high. Now you're adding money when the market's low. So you're buying in at lower prices. So it's really just continuing to stick to that plan, to do the things that we had in the plan for you to do. Or if you're saying, maybe I normally do things at the end of the year, I make an IRA contribution later. Well, if you have the cash and you want to put that to work earlier, that isn't a bad idea. The market has seen a pullback. So when we start to see it go up, you'll benefit from that.
Yeah.
So those are, some practical things. Anything you want to kind of add just practically?
Yeah. I mean, I again, sticking to the plan is really important. I'll just use the example of Roth conversions. So we have people who are nearing retirement or haven't quite gotten Social Security and whatnot yet, and we've recommended doing Roth conversions. And those numbers, our recommendations for Roth conversions, what we're doing, so we're finding a specific dollar amount to kind of fill up low tax brackets. And if you think about, let's just use an example of a client with $1 million IRA, and we've recommended that they convert $100,000 this year. Well, in a normal time, that would be 10% of their IRA that we're implicitly recommending that they convert. But if the value of that IRA declines to 900,000 in a down market, we're still recommending they do that. That 100,000. So they're converting a higher percentage of it. They're getting more of that benefit today, moving into a Roth. And then that actually means less Roth conversions in the future, because the market drop allowed us to kind of front load Roth conversions that would have been done a couple of years from now. So, just sticking to the plan. I know it's hard to do when you see, you open up your statements and values are down and it's like, oh my goodness, I put in $100 this month and now it's worth 80, 85, something like that. But, this is part of the market cycle. And, the most important thing I always remind people is just remember your time horizon. And what we mean by that is, when are you actually going to start using this money? If you're not retired yet, you're not going to start using that money for a long, long time. So if it drops a lot today, that does not have any financial impact on you today. And even if you're in retirement and you're using your money to fund your living expenses, the drop doesn't necessarily mean that you don't have a very long time horizon still, because if you make it to age 65, your chances of making it to age 85 are really high. That's 20 years. So, again, having that well-diversified portfolio where we're funding your living expenses from stuff that is holding up, like shorter term US government bonds, or maybe gold or commodities, things like that. This is where we strategically sell stuff that is done well, so that you're not booking that loss, so to speak.
Exactly. Yeah. And I think those are just the things. And when we feel anxious, and I think being reminded that you're right, I don't need all of this money next year. I saved it so that it'll be there for my lifetime. So that's what we're looking at. And so just stepping back, being reminded of, maybe it's time to turn off the TV, stop reading all the articles, because it is very easy to read something and start to get worried. And when the market's doing what it's doing, everyone talks about it. And so everyone has a story of what they're experiencing or someone they know is experiencing. And so just, kind of catching yourself and not getting caught up in things like that, and just saying, okay. And that's why we wanted to be sure and kind of bring like this voice of calm or reason, and just say, here's what's happening. Because I think knowledge really helps you to be able to understand and to say, okay, I know what's going on. So you feel like you're a little bit more in control. And then also just be reminded of, we're going to go through this, but we're going to stick to our plan.
Yeah.
So.
Yeah. I mean, I'll just say I'm not worried. I'm not,
Yeah.
you know, overly concerned about what's going on. I don't
Yeah.
like to see it because I know it, our clients are concerned.
Yeah.
But this is, you know, this is long history. We go through cycles.
Yeah.
This is not our first rodeo. We've seen this happen before. I firmly believe we've well positioned all client portfolios
Yeah.
for this kind of environment, higher quality companies that have real cash flows, real business models that there is a value to. And that's exactly what you saw in the tech bubble. The best investors owned all the old economy stocks that had great businesses, but were so poorly valued because everybody was chasing these .coms.
Yeah.
Well, we're going to see that same thing play out right now. Metals mining companies, oil companies, industrial companies. I mean, these are real good businesses that generate real money, and investors are going to just simply move from these go-go tech stocks to something else, and we're already positioned for that. So
yeah. So I think our main takeaway really for you today is just, you know, hang in there. Please reach out if you have questions. We want to be able to kind of provide hope. We want to be that reminder when you need it, you know, when you see and read all of this stuff. We want you to be able to move through these times and for us to look back and say, okay, you know, yep, we had those times and now see the other side. So in general, yeah, stick to your plan, but we're here. We're happy to answer questions, and yeah, we're taking this seriously. So we're reading and staying up on everything so we can be here for you. All right. Thanks so much. We hope this has been helpful.
yes, please reach out. Thank you.
All right. Bye.